I love the stock market.
Yeah.
Basically, and I've been at it for a long time, and I like the mark-to-marketness of it. You can pin your value to a very specific point on a minute-by-minute basis. I told them, I don't expect you to get any money. That's my opening line when I tell them about the deal. And they're like,
I probably love you for that.
they're like, great. So this is like easy. We're the ones providing the opportunity. We have the thing they need. Not just that they have what we want the money, I get that. But there's nothing to do for them without deals.
Well, look, thank you for sitting down with me today. And maybe for people that don't know you, would you be able to give just a brief introduction to yourself and background?
Yeah, sure. Well, my name is Ivan Murphy. I'm Executive Chairman at the moment of Arena Rare Earths PLC. And we're listed on the main London Stock Exchange, which has been great. This is a Madagascan rare earth project, which is moving into development and just coming out of exploration. We have a market cap at the moment of about £26 million. So I've been restructuring it since August last year when I became chairman. And yeah, it's been a great few months for us actually. We've really got it under control and moving forward, so it's been good. And my background is in asset management and in investment banking, or well, merchant banking I think is probably a better word for that. Places like Aberdeen Asset Management and Fairfax and stuff like that. So my resources life was an osmosis thing over some years. I worked for Gazprom Bank, where I was more involved in the oil business. Still involved in the oil business in a smaller way, hopefully in a bigger way soon. But Arena is kind of my focus now as a public company that I'm executive chairman.
And you made a point just then, which I think is important, of distinguishing investment banking from merchant banking.
Yeah.
The core difference, of course, is merchant banks underwrite and use balance sheet.
Yeah.
Is there much merchant banking in London these days?
No, there isn't, and this makes me very sad. When I came to London in '95, you had lots of that going on.
Yeah.
And I think it's a real need. You and I have spoken about it before. I'm talking about it every day almost with people. Everybody's saying, yes, that's what we need. And I've tried to pull that together and get something going in that respect, and still trying, because I think it's a great gap in the market, and it's a great business, merchant banking, and I sat next to somebody yesterday at lunch, and they said, oh, what do you do? And I normally just say, I'm a merchant banker, because it's just easier, because I find the capital and the deals and all that. And she said, oh, I work for a merchant bank. Well, it used to be a merchant bank, it's now ING. She was referring to Barings, obviously, which is a good example. But all investment banks were originally merchant banks.
So that's a good point. Like, if we bring that back to the PLC world of today, what impact do you think that has had? What impact do you think the lack of merchant banking, i.e. the lack of brokers and advisors who have their own capital that they're using to put into transactions, what impact has that had on what it's like to run a public company?
Yeah, well, it's had a massive impact, really, because nowadays you have a plethora of brokers who are advisors, brokers, and regulated for that, but they have no capital themselves. So each one is dependent on finding that money from an ever sadly decreasing amount in the UK context, fund managers, and then going out and just kind of hoping that they'll place your stock. I mean, that's a bit facetious, but you know what I mean? They don't have any certainty. And they can't, like in the old days, give you an underwriting agreement and I was talking about my market, like the mid to small market. So that's a big difference. So you're beholden to your broker's recent experience and ability to place stock on a no guarantee, no certainty basis. Which when you're
Best endeavours,
which is fine. But when you're doing transactions with the vendor, that doesn't really stick, because obviously it's hard to get the vendor to say, look, I need you to wait here for 60 days, however long it's going to take me to raise the money and do the placing or whatever the documentation is. But in the end, I may not have it. Isn't very compelling when you're trying to buy something from a vendor. So I think that's where there is a gap in the market. If you had the ability to offer that underwriting to companies of our sizes who are doing the 10, 20, 30, 40, 50 million kind of space, you could have your pick of deals for sure. And underwriters get paid and they make money. It's not like a charity thing. So, and if they go wrong, okay, they may end up with more stock or stock that they don't want. But if you're smart and do it properly, it's a very good business, underwriting and merchant banking. But you need a balance sheet.
And that was something that key difference I noticed coming across from Australia, because in the small mid-cap resource sector there, a lot of the investment banks are merchant banks in a sense that perhaps not for the full thing, but just about every transaction
We'll have some element of that.
We'll have some element of it. Or the initial cornerstone, the firm will stand behind the price. They'll say, look, we can do it at $2 a share because we're putting in the first 300 of the 1 mil that we're raising,
Whatever it is.
which sends confidence. And also, as I understand it, a lot of the principals of these firms, they make a lot more money from the merchant banking side of it than they do from advisory fees.
Yeah, I mean, down there you do have scenarios, as you say, it's exactly as you described, but they also can take very aggressive warrant positions in return for that, and all sorts of bells and whistles, which is, they're right, they're taking some risk. And, you mentioned smaller numbers there, and so in those cases, my experience is they're at the very sharp end of risk, which I get why they get all that stuff. But that can cause, resentment or frustration after completion, because they can just be a very aggressive sellers of your stock and stuff like that. So I think there's a more old school way of doing that, like the older banks in London used to do, which is more based on a proper underwriting agreement for the full amount at price, because they have the balance sheet to support that, but also the relationships. It's really to say, I do have these relationships and I know I'm going to place the stock. Because obviously they're incentivized to place it even more then. But that balance sheet isn't there really at the moment. I can't think of anybody anyway at the moment who's really doing that. And you don't really have to have, if you look at JP Morgan and all these famous story banks, they all came from doing that. It's exactly where they come from. And now, in reality, although they provide huge sources of financing for their clients, they very rarely risk their balance sheet in reality. But the stick of it, or the weight of it, allows them to secure the deals and to secure the positions in stocks they know they're going to place. So if you're getting the deal this year to do SpaceX or whatever, there's no problem placing it, right? But you need to have obviously a balance sheet that looks credible to that. So if you take that into a smaller scale, in our scale, you don't need to have a balance sheet of hundreds of millions, but you need to have some, or at least, I don't want to say the illusion, but at least the vibe of it, let's say.
Create the confidence, yeah.
Yeah. So I've looked at a few to see if there's opportunities to get into that, because I think it would be great.
And so you guys have raised twice in the last 12 months?
Yeah, since August.
Since August. Obviously absent of a merchant banking model to support that. And so how have you, as you've approached that process, what has worked? We'll start with what's worked well. So what have you done that's worked well in executing them?
Well, I think, as I say, I have acted as the merchant banker myself, not by using my own money to underwrite the deal, but to make the commitment that I will find the money myself, right? So I take the principal responsibility for finding the money for the company, and then I go out and get it, is what I've been doing. So, my dream is to continue to do that sort of thing, but have a balance sheet. So that's kind of off your question. But so in August, so the quick history of the company, I think it's important to understand just the financial history, not the story, is it was RTO'd in March last year onto the LSE on the standard transition thingy. So they did that at 3p, but they didn't raise any money. So I got connected to the company last summer after they'd done that. So they were just sitting up on the market, but they'd no money, and they'd done that at 3p, and then the shares had gone to like 1.5p. So I have a long history with this asset, which you and I have talked about before, so since 2010. So I went to them and said, okay, look, I can do this, I can get you the money, and I can reorganize this. So we went to the market then in August 9th, I think it was, or over those couple of weeks, to raise, and we raised about 1.6 or 8 million, I can't remember the exact number of pounds, at the 1.5p, which is really where the last significant piece of stock had traded, which had been Rab Capital had taken an early position after the RTO from a seller. So we used that as the mark, and then went to the market to find the money. Now, I've been doing this a while, and so I'm older than you. So I have like relationships where I've done this before, so I have some kind of go-to funds that I've known for a long time and that I've been working on with other things. But I was very focused on American investors because our strategy is tilted towards providing solutions for critical minerals to the US. So I was purposely looking for some American, or at least American types. So we had a broker. I inherited some broking arrangements, and we added to that then, but really just to help me process that. I didn't assume that they would be able to find any of the money.
Right, so let's pause on that because that's very interesting, because that is quite different to how most other companies would approach the process.
Yeah.
In that they would be relying on or hoping that their broker would also be bringing the money and facilitating introductions. But you're sort of saying in your recent experience, that has been, I suppose, better completed by you driving the process, which obviously means more work from you. But then what role do the brokers play in that process?
Yeah, so that's the nub of it there. So in this market, the way it's been recently, it's getting better. We can come back to that now, I think. But, in August last year, and when we did this other placing a few weeks ago, there's no active market looking for these things. There's no real money chasing these opportunities at the moment, where there hadn't been. So I just worked on the basis that they would not be able to find the money. And I didn't even ask them. I didn't say, can you find me this money? I said, I've got the money, I just need you to help me process.
Right.
I'll introduce the clients and just do the normal.
I hope you got a discounted fee.
Well, no, we didn't pay them anything.
Yeah.
Because I didn't pay them anything on the placing. Except some, corporate fee, a small corporate fee. But there was no placing fee associated with that to them. So I have my own company called Marleybone Capital, which is a cap introduction and arranging company. And that always has to partner then with a regulated bank. Obviously, I only make introductions for the investment. So I used that, and through that then, and with the broker's help, we were able to process these investments.
Okay, so you're in a unique position compared to most other public leaders in that you've got this experience and the network.
I've worked in this, I've done the other side a lot. So I worked for quite some years in a small investment bank, small advisory bank. So, I've done this loads of times for different clients, not for myself. So now I just try to do it for things that I only do it for things that I'm inside myself. So I'm in the company. And so my merchant banking model, I suppose it's funny because I hadn't really thought about it like this until now that we're talking about it. In return for that, Marleybone Capital got some fees and also got some warrants in the company as a little mini merchant bank advisory thing. But it doesn't have a balance sheet and it wasn't underwritten.
So if someone doesn't have that level of experience, expertise and connection, if you were, say, talking to another, CEO of another exploration company and they said, well, look, we're going to need to, we're funded for this year, but we're going to need to fund our program in 2027. What would be the three things you'd suggest to them to start doing today?
Okay, well, the first thing that they don't now, the very first thing is the market's getting a lot better. So that's
a positive.
So that might take away a lot of what we're talking about. I don't know. Let's see. But I was at Indaba a couple of weeks ago for the mining conference, and there's just a palpable sentiment change towards the sector and money for it. So there's a lot of money now does want these transactions. So that's the good news if you're in the exploration or mining resources space. And I don't think that's not going to continue for some time. Which would mean all these brokers who've struggled over these last years in a really tricky market, will start to be able to deliver the older type of thing, which they'll be able to say, yes, I will be able to place this, not underwritten. So I think, but to answer the question, the three things I would say is, I'd say the three things. Number one is, first of all, the market's getting better for you, so that's great. But the second thing is, you can't rely on the broker to find the money.
So build your own relationships.
Just build your own relationships, yeah. And if you have it, if you're already listed and you already have shareholders, that's brilliant. So really focus on them because they're already in.
Much easier to get someone to follow their investment.
1,000%.
Yeah.
So, and that's what we did. So one of the things I started with when I took control of this company last year, or got control with the board, is they already had wrap capital. So he was in before I came back to it. So he had bought 5% at 1.5p or 4 or 5%, and that gave me a lot of confidence then. I said, okay, good. So at least I've got him, and the rest were really quite, retail, which was fine. And actually, that's not fair. There were 2 other really nice family offices in there. So I had that, and that was a big plus. So that was a bit of, at least a base, somewhere to start. Now, RAB didn't actually do anything in that placing, but they then subsequently, and I can come back to that, we did a convertible then with them later. So actually we've done 3 raisings since August. Sorry.
But I imagine with all of those investors, but also ones that you've brought in since, you have a unintermediated relationship with them. They know you.
Exactly.
You have the direct engagement with them.
Exactly.
Right.
100%. So all my shareholders, all my main shareholders, I have direct relationship with them. There is no broker between us. And there's no, I think there's downsides to that, because obviously they text me all the time.
Yeah.
I don't, so,
but I suppose it means because the worst, at least from what I've observed, the worst time or the worst sort of experience in raising money is when all of your investors are very surprised and they get a call from you and it's like, yep, we need to raise 3 million. Can you help out? And I said, well, where have you been the last 12 months?
Yeah.
I don't know what's happening. I need time to get across the story.
Yeah.
But it sounds like, and I'm putting words in your mouth a little bit, but it sounds like because they have that relationship with you and they know what's going on and they feel connected, it's not as much of a jump when you do need to raise money for them to go from where they are to being willing to put more money in. Does that make sense?
100%. And so you've got to have that kind of regular communication, but also you can communicate to the, when you're in my sector, there's no secret to the fact that you're going to need more money, right? So you're always obviously just trying to do it at a better valuation, and when you're further along the curve with the money you've just taken, right? So I've taken 3 lots of money since August. Now with that money, I'm going to be able to get 2 more steps forward, right? But everybody knows then I'm going to need more. I mean, I have a PFC that's published that's going to need 150 million. So there's no secret about that. So, but if you communicate that properly with the market and you're regularly updating about your financial needs, which we do, like I tell people when they ask me how much money I'm going to need and when roughly, that's not against regulation. That's just setting out your course. There's no secret to it, right?
I think some companies are scared of that. And I think particularly in resources a little bit easier because PFS, DFS, BFS are published, and so the capex requirements are known.
Yeah.
But let's say you're in biotech, similar-ish in a sense that it's binary outcome, for lack of a better term, and that you require more money as you move through the process towards commercialization. But also should be well known that you need money along the way. But I think sometimes companies will try hide the fact that they're going to need more money, which creates more of a surprise when it comes around.
Yeah, and this is based on this kind of conception that, my shares won't continue to perform because everybody knows I need money, so they're just going to keep waiting until I need more money. Now, if you go down that route, I don't recommend that. Instead communicate to the market that, I'm going to need more money, but I'm not taking it until I have a better valuation. So fine, I can wait because I've now got some money. So, or certainly that's the way I do it.
And it makes sense because if you communicate that well, then people realize, well, we've just taken in 3 million to do this expansive drill campaign. The results of that, assuming they're heading in the direction we believe they are going to take us up. And so you can sit here and wait to the next raise, but that's going to be at a much higher price, to your point. And so there is still upside to be found by getting in now.
But you can do this. There's no, in mining and in resources, maybe even more so in mining. Well, in oil and gas to a certain extent, but let's just stay on mining for now. But in mining, most mining companies will issue a PFS, right, which will tell you in their RNS the NPV of the project and how much they're going to need to get it into production, right? Now, their share price, let's say, is 2p, and their valuation is 10 million. I'm just making the numbers up. But their PFS says their NPV is 200 million. Okay? Now, they're going to need more money to spend to get to that NPV and do these other things. But at this point, between that point of issuing the PFS and getting funding for it, all mining companies are at their steepest value curve in terms of growth, value creation, right? That is the massive gap.
First part of the Lassonde curve.
Yeah, exactly. So, there's no point in trying to hedge your bets around the best moment there if you're an investor. You just get in there, right? And then wait. And then hopefully that'll deliver. And then you're going to see that's where the big alpha return is, obviously.
Mm.
whatever the right word is. That's there, and then it becomes more defined, and then their market caps catch up in these companies, right? So, their NPV is 400 million, and eventually they get to 200 or 300, and people go, okay, well, now you're going to have to show me something else because I'm getting close to it now, and you're getting closer to it. So then they get bored, and then you either just do something, either bring in another deal, or you're always looking.
It's a different type of investor that comes into that.
Yeah, well, exactly. So then you're into a different range of institutions, a different type of, a very different profile of investor.
So, go back to the 3 points. So, market's getting better.
Yeah. So that's already going to be
which
easier.
is great. To form your direct relationships and essentially start the sales process, because it's a sales process yourself. Because of course, if you do need to go to a broker, I imagine it's a great deal more difficult to go and say, well, look, I need 5 and I actually have 3. So I need 2, but I've already got the 3. The price is set. This is a partially filled deal. Much easier for your broker to then go and do their thing if there's a running start.
Absolutely, because what they want is the easiest deals.
Well, yeah, they want to fit as many in as possible.
Yeah, which is fair enough.
Yeah.
That's their job. So, in the last 2 examples, in our examples, the last 3, I told them, I don't expect you to get any money. That's my opening line when I tell them about the deal. And they're like,
I probably love you for that.
They're like, great. So this is easy. And that's, now, as the market's getting better, I can see that there's more demand from the brokers to say, well, we think we can probably get you some money now because the market's better for them. There's just more people willing to do it.
Let me ask you this though. Let's fast forward 12 months. Let's say hypothetically there is a scenario that is 3 times better than now. If you have already proved that you can do this yourself in the absence of paying broker fees, why would you use the brokers? Even if they do have the money? Because if they have it, doesn't that mean it will be easier for you to get it yourself as well?
I think, yeah, but I think I think there's a tipping point in scale there where,
Right.
the broker then has you'd also be in that scenario in a year's time, or whatever it is, you'd probably have a bigger bank broker than I have now, maybe.
Fair enough.
Because you'd be in a different place. But the thing is, you'd already have some on the register, which means you've always got the base that wants your deal. And I think the other thing that I would say on that list of 3 or now 4 things maybe is if you can identify investors when you're smaller who are much, much bigger than you need. So I have shareholders who are running multi-billion-dollar portfolios and my company is tiny, right? And if I triple their investment, isn't going to make any difference to them. But what it means is they're committed to knowing that I do need 150 million or whatever my...
So start preparing in advance.
Yeah, because you want to have them there. And the other great thing about them is they're not going to sell short term when the price goes up a lot. Because it doesn't make any difference to them. They're there for the longer thing and they want to put more money to work. Because if you can get at the guy who has to put more money to work, it's obviously better than the guy who doesn't need to do that. Because really they're hoping that I'll come back and ask for 150 million.
And by that point, they know you, they know the story, they've already
They've been in for a while, so they've made some money, fine, but now they can put 20, 30, 40 million to work, or 10, 20, 30, whatever, whatever it is. And that's, and I think that's the other thing to remember, I think, when you're doing these things as a public company executive, we're the ones providing the opportunity, not them. They just sit managing money, that's their job. If they don't meet people like us, what are they going to do? So, we have the thing they need. Not just that they have what we want the money, I get that. But there's nothing to do for them without deals.
This is a fantastic point, and it's actually a very nice segue into something else I wanted to talk about, which is I believe that for better or for worse, the main commodity in the market is the public company. And that's the commodity for the banks in that's what they're selling to their investors, that they might get brokerage fees from, it's what they're raising through, how they get advisory fees, it's how the PR firms make money, it's how the lawyers make money. The core commodity, the only reason why people are coming to this venue to exchange is because of the company.
Exactly. So you need to, and it's hard for me as well. I mean, not saying I've mastered this at all, but I have to constantly remind myself when I get exposed to these big funds that got loads of money, I say, they need me. Yeah. Because
so be confident.
Yeah, be confident. And also, have that commitment to your story and that what you're selling is what they need.
Mm.
Because otherwise, if you go out the door and they don't do your deal, they have to find another deal to spend their money. And most of them are long money, short deals, good deals, right? Now they'll say, there's so many deals in the market, I can do whatever I want. And then when they like you, say, you're going to have to give me a discount because I've got all the money.
Mm.
In a recent placing we did the placing, and I told them I would only take the bid price. I didn't want to take a discount.
Mm.
And I didn't want to take the discount not just because I didn't want to take the discount. Obviously nobody wants to take the discount. But I wanted to make the point that we don't have to be taking discounts just because we're small.
Mm.
There's just this there's been a very tricky market for the last couple of years. So there's just been this accepted discount thing.
Mm.
I'm like, well, why is that accepted? Why do I have to because I'm small? So you expect to just kind of screw me? So my attitude is, that's got to stop.
It's a good point, right? Because it's sort of a bit of a sticky pricing phenomenon in that if maybe 100 public companies came together and just said, we are not taking discounts, wonder what impact that would have. Because that would sort of force a change in the sticky price in the market, no?
Yeah, I think that would work, but I think but everybody can just do that themselves.
Mm.
Next time they go, they can just say, I don't take this discount.
Mm.
Because they're opening things, well, there's going to be a discount.
And that's easier to do if you can bring some money to begin with.
If you can bring some money and just realise that there's loads of money. There's no shortage of money in the world.
It's just finding it and nurturing it.
Just finding it and nurturing it, and it's shoe leather, you just got to, it's exhausting. You just got to keep battering away at it. And then, we're now through that. We've got some brilliant investors now. We've announced a big one recently. So, we've got a brilliant register and a great group of people. So I know now, with a couple of calls, I can raise money.
So the other side to raising money, of course, there's finding the money to fill the deal, but there's also getting the share price to a point at which you're happy to raise. And that is something that, and you can feel free to disagree with me, that I think the equation there has changed as well. Because, of course, 10 years ago, to just pick a round number, it was more the case that if you were good business, good management team, good equity story, you did what you said you were going to do, you had good broker relationships, lots of desk notes flying out, the market would do its thing. Don't think that's the case anymore, in large part. In that there are a lot of companies, might be different for you, but there are a lot of companies that do all the right things. They put out a fantastic RNS, or share price goes down. The market isn't working as well as it used to. I believe that that's because a lot of the liquidity is now not going through, the day-to-day liquidity is not through those investors that use a full-service broker, but it is the broader public, which I actually think is a good thing. It's good to share the wealth creation opportunity with everyone. But the way of addressing that part of the market, so non-institutional, is very, very different and can be quite challenging. Do you agree with that, and how have you thought about that?
Yes, I think a lot of that is true. I think that the kind of structure has changed, as you've said, from that kind of traditional. But I think that that has really been a function of a terrible market. I mean, I'm talking about the UK here. I'm talking about the US. So in the UK market, it's just been so bleak these last few years with this compounding, exiting from small caps, all money chasing the Nvidias and all the megalopolis companies, whatever they are, a constant diminishment of liquidity, right, in shares here, which has, made it even less attractive. And then on top of that, the UK long-only fund managers are on general withdrawals from their funds, which means they're forced selling the very things they're supposed to be investing in because they're getting withdrawals in funds that are small company funds, so they're forced, so it's just crushing the prices. So what's happened then is a whole host of companies have moved into what a friend of mine calls like the LSE hinterland. It's just like it's just this lonely place full of companies that nobody cares about anymore. So I think it's been a really tough time for them, and we don't have time to talk about regulation and government, but that has compounded it also, and share ownership, and there's certainly not been enough focus on that here, not like in the US. So that's made all those things more difficult. So that traditional, I'm just going to do my job, have my broker note, and it'll all just sort of take care of itself. I think that's not enough. You can't rely on that to happen anymore the way it kind of used to. because of the change in that investor base, as you say. So when I came to London '95, you'd way more institutional funds, let's say, kind of, and they would care about all that.
Specialists as well.
Specialists, very kind of narrow focused things. We have a couple of them left, but not that many. So, whereas now the retailer, like, is the retailer reading my recent research note of 46 pages?
Probably not.
I'm going to say he isn't. So how do I communicate all the good that's in there in a way that's, that they can digest? And so I think that's something that's new to me over the last year, having gone back to this public company. And we've done a lot of that. And I don't know, it's, I inherited a set of relationships in that area, that kind of retail focused, social media focused communication. And it's coming to an end because they were taken on at the RTO in March, and so they're coming to an end. So we're right in the middle now of trying to understand with the board, which I'll be doing with them next week or at the end of the month rather, is, okay, what did they do? And did it work? And did it do anything? And I must say, I was really negative about it in August when I came back in and became an executive in the company, that I was poo-pooing it a little. This is not going to work. This doesn't seem like any better. But I stuck at it, and I have stuck at it, and I've consistently done a lot of it. And I do think, although maybe hard to quantify, I do think it has worked to a certain extent, yes. But it's taken time. A lot of it felt like you're shouting into the void. What am I doing this for? But I would say, I think it's now got a bit of momentum, and I think and I basically think you have to do it.
I think the world's just changed.
Yeah, exactly. So I don't think you can not do it, basically. And I thought maybe you didn't have to, and I was wrong about that. So I've definitely learned that. I think there's better good and bad providers in there. I think you do need to pick ones that are more you like. In addition to that, I do have more traditional PR help with a more normal London, like a more, it's like old school, let's say, PR. I just actually bumped into him on the way here. Because his office is near here, and he probably wouldn't like me saying that, but it's true. So I have kind of new media things. I don't know if they even call it that anymore. But then sitting on top of them, we have a very traditional, long-standing, City of London financial PR person who does my sector. So the combo has been great. Actually, I think that has worked.
I think the key point that you made before is that the world's changed, and so you can't ignore it. That traditional approach, which we've talked about a couple of times now, of do the thing you say you're going to do, have the broker relationship, put the note out, and the market works, isn't there.
It's not enough.
It's not enough, unless you're a FTSE 250 company, maybe it is. And also and I don't think it is just necessarily retail who are putting in, £500 or £1,000. Even people a bit older and a bit more sort of sizable. If I'm scrolling through my phone, I'm very unlikely to stop on a post and sit there for 30 minutes reading a document.
Absolutely.
No one does that.
No.
And people also, I think there's been most investors, perhaps when you started in the market in the 90s and early 2000s in London, would have been at their computer doing this as their day job. But now most investors are on the move, they're looking at different places, and so we do sort of need to meet people where they are.
I think there's no doubt about that. I mean, if you look now even on Revolut, you can buy shares on Revolut, right? And, I use Revolut to send my daughter pocket money, basically. But now I've realized that people use it now as their fully fledged bank. I know that's obvious, but I'm a bit more behind the curve on that. And they are buying more stocks and shares and ETFs and stuff like that on it. So they're not going to read my 30-page research note.
Not initially.
Not initially. So I do think that you have to have both, and I do think the other one is that new way of communicating is fundamental. You've got to be on that. And I'm a convert, I should say.
There you go. All right, well, final thing, because we could talk about that for hours, to end on some even more positivity. And we covered this at the dinner you came to a couple of weeks ago. What is your favourite part about being a public leader or involved in public companies?
Oh, okay. Well, I love the stock market.
Yeah.
Basically, I've been at it for a long time, and I like the mark-to-marketness of it.
Yeah.
That you are you can track
And slice both ways.
you can slice both ways, but it can't be argued with, right? So
Yeah.
you can pin your value to a very specific point on a minute by minute basis, and you can do things quickly. I mean, that's still true of the stock exchange, right? So you can do things quickly. You can make acquisitions. You can raise money. You can shift a little bit to something if you want, and I like that flexibility. And so if you get a market moment, which we're in now in my space, where critical minerals is a huge story for these next years, then it's brilliant because it really works. And I would end by saying that the AIM market, which has been under a lot of critique, let's say, over the last couple of years. I mean, they are making a lot of changes. They have pushed through some changes now, and I'm not on the AIM market myself at the moment. We're on the LSE, but I have a long history with it. I've been involved. I've been on boards of AIM companies, and I'm actually starting to, having been very negative and expressing those things to colleagues at the LSE. I think there's improvement there, and I think there could be a lot to look forward to in the London market. On the smaller side and more listings, and AIM maybe getting another go at what it was really good at originally, which is allowing companies to get access to capital in a good quality market like the LSE, which it is, no doubt about, the oldest stock market in the world. So I'm optimistic.
There you go. Thank you, Ivan. Good note to end.
Thanks so much. Good to see you.
Cheers.